Now, the big problem that I'm going to give you a solution to in this video are these external factors. Things like previous wins and losses. Things like an argument with your wife or your husband or your spouse or your boyfriend and girlfriend. Things as small as having a cup of coffee or as big as unresolved childhood trauma sitting in the subconscious mind. These external factors are going to influence the way you feel. If you've had a previous win the previous day or that morning, you're going to be puffed up in this state of being happy and self-exaggerated and overconfident. Or if you've just had a coffee, you're going to be very happy and self-exaggerated. You're going to be feeling really good. Or if you've taken a previous loss or you've had an argument with your wife, you're going to be in this state of being sad and depressed and down. And because the way you feel is different, then the way you feel is also going to alter your perception of risk. If you're feeling very, very happy, then what's going to happen is you're going to minimize risk in the market. You're going to puff yourself into this state of being overconfident, feeling a little bit invincible, and you're going to minimize the risk in the market. You're not going to take the risk as seriously in the market. Or if you're feeling really, really sad, you're going to amplify and exaggerate risk. You're going to overthink things, and you're going to make the market, risk in the market, bigger than what it actually is. So the way you feel alters your perception of risk, and your perception of risk alters your decision making. If you're minimizing risk in the market and you're feeling very happy, guess what you're going to do? You're going to come into the market, you're going to deviate from your trading plan, you're going to force crappy trades into the market, thinking that you can take something from the market when the market's not ready. You're going to overtrade out of greed. You're going to be trading based on what you want from the market as opposed to what the market's actually providing to you. So your previous win, your cup of coffee, these can all impact your decision making and make you overtrade on that particular trading day. Or if you're feeling sad and you're amplifying risk in the market, you're going to undertrade out of fear. And if the market presents an opportunity that usually aligns with your trading plan, you would usually take it. Because of this depressed, saddened state that day, you're not going to trade because of fear of taking a loss, because of the fear of being wrong, or all those components. So these external factors are going to impact your decision making. Now, so too, if you have unresolved childhood trauma or trauma throughout your life that's accumulated and stored in the subconscious mind, what can happen is when you experience a trading loss, that trading loss through association can resurface some of the traumas. For example, a loss of a loved one, a loss of a previous relationship, or it can bring to surface even deeper unresolved things from your childhood. And what can happen is that loss can make you relive those childhood traumas and make you feel the same experiences and the same feelings as what you would if you were reliving those childhood traumas. So anything unresolved in the subconscious mind, again, is going to affect how you feel, your perception of risk, and your decision making. So if you have a trading strategy with proper risk management, what I'm trying to highlight here is that being able to manage your psychology and master your trading mindset is a crucial component of being able to stick to your trading plan and reap consistent profitability as a result. Now, every individual has some degree of a mood swing, right? Let's imagine this is a weekly chart of the time versus how you feel, positive, negative. Now, in all probability, how you feel over a week is going to alter due to your perception of external factors. For example, if you perceive something really good happening to you Monday, Tuesday, you're going to be more on the elated side, more on the positive side, more on the happy side. And then maybe you get some unmet expectations later in the week, and then you feel a little bit down, and then up and then down, up and down. And to be fair, for a healthy human being, this is very normal. Everybody has some degree of a mood swing. Some swing more, some swing less. Now, the same is true on a daily basis. How you feel is going to alter. Maybe after your cup of coffee, you're going to feel really, really good. Maybe after a large meal, you're not going to feel so good. Maybe if you have a really positive, loving conversation with someone that's meaningful to you, you're going to feel really good. Maybe if you get criticized by your boss at work, you're not going to feel so good. So in all probability, everybody's going to swing some degree throughout the day as well. Now, your results are going to stay inconsistent if you let how you feel and these external factors impact your decision making. And if you don't have a tool to to be able to manage these external factors and how you feel, they are going to affect your decision making. So this is what we're going to get to. So what I want you to take from this is do not expect consistent profitability if you can't manage your psychology and consistently stick to your trading plan and consistently trade the same way every day without letting your mood swings or external factors or previous wins and losses affect the way you perceive risk and as a result your decision making. I'm going to give you a tool to be able to manage this. So this is exactly how you develop a bulletproof trading mindset and gain an instant edge. You have to learn to gain control here, right? The moment you perceive external factors, we have to have some sort of a tool or process to redefine what these external factors mean to you and alter the way you feel, and then alter the way you perceive risk in the market before you make a decision. So that when you come to the market, the way you make decisions in the market is consistent and you consistently stick to your trading plan. You don't let your perception of risk or how you feel impact your decision making. But you have a tool or a process right here to ensure that irrespective of the external factors, that's not impacting your decision making in the markets. And that you can consistently show up at the market, you can consistently stick to your trading plan, and as a result, you can have consistent profitability. So that your execution can be consistent or stable, in other words, and you can have consistent profitability as a result. Now, the other benefit you get from this is you also have a replicable mental model that allows you to scale. Many traders struggle to scale because when they go from their $10,000 account to a $100,000 account, all of a sudden the wins and losses are bigger, and these bigger swings of wins and losses now affect how they feel, they affect their perception of risk, and now all of a sudden they're scared to take losses so they don't trade, or they're greedy over wins so they take bigger trades and more trades and overtrade. So being able to have this replicable mental model that keeps you stable and balanced before you trade and doesn't let external factors affect your decision making is not only crucial in having consistent profitability, but it's also crucial in allowing you to scale from 10,000 to 100,000 to 1,000,000 and beyond. Go as far as you want because now you're not letting the external factors affect the way you trade. And this is exactly how you do it. The first thing the top 1% of traders do is they have a high level of awareness of what type of decision they're making. Just before they're about to take a trade, they become aware, okay, am I taking this trade because of what I think the outcome of the trade is going to be, because what I think is going to happen based on what I expect from the market, or am I taking this trade because it aligns with my trading plan? Those are two different types of thinking. One is outcome-based thinking. One is based on what you think the outcome of the trade is going to be. I'm taking this trade because I think it's going to be a win on this individual trade. That's not how the top 1% of traders are thinking. That's how the bottom 99% of traders are thinking. The top 1% of traders are only taking trades because they know, irrespective of the outcome of this individual trade, I'm taking the trade because it aligns with my trading plan. So the first thing you need to have is awareness of what type of decision you're making. Now, if you catch yourself and you see that, all right, I'm expecting something from this individual trade. I'm expecting an outcome, a beneficial outcome, a positive outcome. I'm expecting $10,000 or 10%, or for me to pass my funded challenge, or I'm expecting for this trade to give me a win so I can post to my community, so I can raise my status as a trader, and I can get recognition from my trading community, or I'm expecting this trade to give me a certain amount of money so I can pay rent. These are all the expectations that we impose on the market, on the individual outcome of the trade. If you become aware of what those things are, you have to get very good at, number two, grounding those expectations. You have to remind yourself that nobody knows and nobody can predict the outcome of each individual trade. There are millions, if not billions, of factors influencing price at any point in time. Firstly, we don't know what all those factors are, and secondly, we have no idea how those factors can influence price. So who are we to think that we can predict the outcome of the individual trade? And then you want to remind yourself that it's not about predicting the individual outcome of the trade. It's about sticking to your trading plan over 100, if not thousands of trades. Because you have a proven edge, you will reap consistent profitability over the large sample space. The individual trade may be a win, it may be a loss. Who cares? I stuck to my trading plan. I know if I do that 100 times, I'm going to end up profitable. So it's about awareness of what type of decision you're making. It's about grounding outcome-based expectations and grounding this thought process that I'm taking this trade because I think it's going to be a win. Grounding that because that's unrealistic. That's an unrealistic expectation. And then number 3, it's about reminding yourself, all right, I'm only going to stick to my trading plan on this individual trade. I'm not thinking about what I'm going to get from the market. I'm taking this trade because it aligns with my trading plan. This is the exact step-by-step thought process of the top 1% traders.